Assalamu alaikum. Welcome to lecture 17 of tax. This is the second lecture under corporation tax. The first one was under lecture 16, which was just the basic introduction to your corporation tax. So under corporation tax, we have gone through the corporation tax rates. We have gone through how to calculate taxable total profit, your TTP. Because based on this, we are going to calculate the corporation tax. So lecture 17 is going to expand on your taxable total profit. So this lecture is going to be detailed on your taxable total profit. This lecture is so important for your corporation tax because without your TTP, you will not be able to calculate corporation tax. So let us start with lecture 17. Here we are going to go through your TTP, tax adjusted trading profit, disallowable expenditure, pre-trading expenditure, charitable donation, property business income. See, can you notice one thing? These things we have covered for our income tax as well. Property business income, charitable donations, disallowable expenses. Okay, while we were calculating trading income, from there also we have deducted this. We have gone through expenses and the various types of income. Now in corporation also we are going to go through them. Then interest from the point of company. Then capital allowances for companies. Capital allowances for individuals, for personal taxpayers we have covered in lecture 7. That's the basis of capital allowance. You need that knowledge for companies as well. Key differences of capital allowance with companies. Enhanced capital allowances for companies only. This was not there. I haven't taught you this. Then disposal of assets where enhanced capital allowances are claimed. Enhanced capital allowance restriction. Enhanced capital allowance for expenditure between 1st April 2021 to 31st March 2023. Capital allowance planning for companies. Property business income. Difference with corporation and income tax treatment. Long period of account. The two computations. Ruling for allocating profit. Capital calculating liability. Long period of account we have covered before. Okay, for our chargeable gain. Now we are going to do it for corporation tax. And then finally we are going to conclude with which part of the syllabus did we touch. Then summarize the entire lecture and what technical articles you need to read for this lecture. Okay, so under this TTP, we need to deduct capital allowance, then we need to add property business income, and if it's long period of account, we need to allocate the profit. So now this is like your pro forma of TTP. You were introduced to this briefly in previous lecture, lecture 16. Now we will expand on the detail. So as explained in lecture 16, corporation tax is charged on your TTP. This is the following pro forma is a remainder of how TTP is calculated. So let's assume a company ABC. So for ABC Limited, we are going to calculate the corporation tax for the year ended 31st March 2025. Remember, corporation tax are always calculated for the accounting period, not tax year. So we start with trading profit. This how do we calculate? I've covered this in the previous chapter, previous lectures. Property business profit. Okay, then non-trade interest. Remember, trade interest you will be adding with trading profit. Non-trade interest separate. Then other income. Then chargeable gain. Chargeable gain also we have covered. Then all together you add, you get your total profit. From here you deduct qualifying charitable donation, your QCD. This will be given to you in the exam, the amount of QCD. Then you get your taxable total profit. Taxable total profit means this total profit will be taxable now. On this you have to pay corporation tax. Remember, if your TTP goes wrong, your corporation tax goes wrong. Okay. So the following section explains the calculation of TTP in more detail. Now, so we are going to expand upon this item, trading profit. So starting with tax adjusted trading profit. One by one we'll touch, one item at a time. So we start with the trading profit, which will be adjusted for tax. Hence, tax adjusted trading profit. So profit adjustment that we have gone through in lecture 6 while calculating income tax applies for corporation tax as well. Okay, companies use accrual basis, not cash basis, and the tax adjusted trading profit are generally calculated with the same principle that apply for income tax purpose, where you adjust your profits for non-trading income, capital gain. What happened? See, this non-trading income and capital gain were included while calculating accounting profit. Now you take them back. Okay, and any expenses that needs to be deducted, you deduct. That does not need to be deducted, you add back. Then, so these are the general principles of profit adjustment. Okay, remember the general principles were covered in detail in lecture 6. Please go back to lecture 6 and revisit. So now we will be including the following that applies to corporation tax. Amounts that are not taxable as trading income, like your investment income, your non-taxable income, your capital profit on sale of assets, you will see this amount that are not taxable as trading income. What do? That you have put as an income under trading, deduct. Next, disallowable expenses that you cannot deduct but you have deducted. Now you need to add back. Capital profit on sale of assets, specific disallowable expenditure, or revenue expenditure that are too far away from trade, that means remote, and accounting estimates. These are disallowable, you can't deduct them. Then deductible amounts that has not been charged but you have to include. Are capital allowances. So this you can see the detailed section 2 of lecture 7. Then annual proportion of income element of lease premium. This also we have covered under when we were doing property income for income tax. So you can watch that lecture. Then pre-trading expenditure. So pre-trading expenditures, if it's a revenue expenditure, you can deduct incurred 7 years before you start trading. And if it's a capital expenditure, via capital allowances. Then there are specific points you have to remember when you're adjusting the trading profit for a company. What are they? Dividends. If it's a dividend, okay, they are not your tax deductible expense. You can't deduct them as an expense. It was covered in previous lecture. So if correctly it has been disclosed in the accounts as a deduction from profit after tax, that means dividend is a deduction from profit after you have deduct corporation tax, then there is no adjustment that is required if it is correctly disclosed. If it's correctly not disclosed, then you have to do an adjustment. And remember, dividends are an appropriation of your tax profits. They are not your expense, because after the tax only you're taking it out as a dividend. Then next point is allowable expenses. This following allowable expenses you do not have to adjust. First, director's remuneration, even if the director is also a shareholder. These are your allowable expense. That means you can deduct as an expense from your profit. Director's remuneration, interest payable on loans, and overdraft that you are taking for trading purpose. For example, you want to fund your working capital, you want to expand your inventory, or you want to purchase non-current asset. All these are trading purpose. Then any incidental cost of raising loan finance you can deduct. They are your allowable expense, except when the incidental cost is relating to share capital. That means you're issuing shares. That time you can't deduct. Then this following are your disallowable trading expense. You require adjustment for this. You're not allowed to deduct. First one, QCD. We'll cover this in this lecture in section 1.5. Then non-qualifying donations. Okay, if you're giving a donation to a local charity in return for free advertising, that is known as non-qualifying donation. Okay, non-qualifying donations may however be allowable. See, we are not going to talk about non-qualifying donation for now. Our attention will be on qualifying charitable donation. They are disallowed. Yes, QCD you can deduct, but from your total profit, not as a trading expense, not from your trading profit. This QCD. Next, interest payable on loans that you have taken for non-trading purpose. Trading purpose, yes, allowable, but non-trading purpose, not allowable. For example, you have taken a loan to finance an investment property or shares. Then depreciation. Depreciation is disallowable. Depreciation on tangible assets. Even if that asset is used in the trade, depreciation is disallowable. Okay, so what do? We generally offset this by capital allowances. The same way how we have done for income tax. Rather than depreciation, we deduct capital allowance from our profit. Now, so these are some main examples of your disallowable expenditure. First is capital expenditure. Okay, so capital expenditure and depreciation are disallowed. This was explained in lecture 6. Same as for capital income tax. Right? Now, in addition to this disallowed capital expenditure, the following costs are disallowed for companies. So we have covered some disallowable capital expenditure. Please go back, revisit my lecture 6 and see the list of disallowable capital expenditure. We are not going to expand on this here, but we are going to go through the following costs which are for companies, disallowable for companies specially. Okay, so any incidental cost incurred, if it's for loan you can deduct, but if it's for issuing share capital, they are disallowed. But there is an exception. Exception means when it will be allowable. If such costs were incurred by companies in raising loan agreements and loan stocks, which is allowable for corporation tax. In that case, it's allowable. But incidental cost on share capital, not allowable. Then, second category. First one was capital expenditure, which was disallowed. Second is expenses not incurred for trading purpose. This also, expenses not incurred for trading purpose also covered in lecture 6. But this following costs are disallowable for companies especially. Expenses deemed against public interest. Let's say any fine you have received, interest on underpayment of tax, penalty, they are disallowable. And interest payable on non-trade purpose. Let's say to purchase a let property or improve a let property, disallowed. Then the third category, appropriation by directors, disallowed. As an expense, you can't deduct them. But the remuneration, see, appropriation and remuneration are separate, okay? Remuneration, that is the company directors remuneration package that you are giving, is an allowable expense for corporation tax, even if the director is also a shareholder of the company. Okay, now the cost of providing employee with an asset that employee is using. Okay, let's say private use of the asset, and where the employees are paying for the personal expenses of employees, you can deduct them as an expense, because this is a benefit that you are giving to an employee. For the employer, they can deduct because they are giving a benefit to an employee, and that benefit will be taxed on employee as a benefit, as the income. Now, pre-trading expenditure. So for corporation tax, pre-trading is treated as income on the first day of trading. This is same as in your income tax, no difference. Even in the under income tax also, pre-trading expenditure we treat as if it was incurred on the first day of your trading, even though it was incurred before you start trading. Now, for the tax purpose, this is how the relief is given. Okay, the pre-trading revenue expense incurred up to 7 years at the first day. That means you can deduct them from your profit. They are allowable. Next, Pre-trading capital expenditure relief will be given by way of capital allowances. Then there are no adjustment is required to the trading profit shown in the accounts unless, see, if the trading profit shown in the account, you don't have to do any adjustment unless these things are there. Number one, expenditure was capital, but you have put it as revenue. What did you do? You were supposed to capitalize, but you have deducted it as an expense. Now add back. Or expenditure was revenue, but you were not supposed to deduct it from the point of tax. It's not eligible for tax relief, but you have deducted. Now add back. Do the opposite. Or expenditure is revenue. You can deduct also, it's allowable also, but you did not. You ignored the amounts. Now deduct. So, isn't it very easy? Now, next part, charitable donation. Okay, so from our pre-trading expenditure, all this while we have been going through expenditures, pre-trading, disallowed, allowable. Now we are moving on to charitable donation. This also you can deduct from your total income. So companies can claim tax relief for donating in charity. They are not your trading expense as shown in the pro forma. Rather, you deduct it from total profit. So qualifying donations can be a single payment or a series of payment. But unlike the personal taxpayers making gift aid donations, qualifying donations made by companies are always paid gross. This is a good thing. No grossing up. Always QCD are gross. Now, the next, property business income. So all this while we have been focusing on RQCD. Then our trading profit. Now we are moving on to the next type of profit, that is property business income. So under this, we know what is property business. Any profit or loss from letting a furnished or unfurnished property for a period of account, which is usually your accounting period for company. So see section 4. We'll cover this property business income, how to calculate it for companies in section 4 of this lecture. Now the next, interest. In that pro forma, we have interest also. Interest, both income and expense for interest. If you receive it, it's an income for you. If you have to pay the interest, it's an expense for you. So income and expense, that means that arises from borrowing or lending, are dealt under loan relationship rules for your corporation tax. Remember, if it was personal taxpayer, sole trader and partners, this loan relationship rule does not apply. It's for companies only. So expenses and income include any debt that arise from borrowing of money or issue of security, any interest from lending or investing money from bank deposit or loan notes. Then remember, the loan relationship can be of two types, trading or non-trading. If it's trading, you don't have to adjust your profit. If it's non-trading, then only you have to adjust. So it is unusual to have loan relationship trading income unless the company's trade is lending money. See, your trade has to be of lending money, then only it can be a trading income for you, the loan relationship. Otherwise, for most of the company, this remains non-trading income only, your loan relationship. You're understanding the interest that you're receiving and being. Usually it does not come under trading income. But if your trade is only lending money, for example, banks, what is their prime duty? Lend money, right? For them, it falls under trading income. So, if it's your trade, then they are your allowable deduction. Now, non-trading. So, from trading, we are moving on to non-trading. If it's non-trading, most of the time you will see it's a non-trading, normal businesses. So, they require an adjustment of trading profit. So, interest that you have received from banks will be assessed on accrual basis for corporation tax. We all know because companies prepare accounts on corporation tax. Sorry, on accrual basis, not cash basis. Now, so interest expense and income are recorded in the accounts. They are treated as taxable debits and credits. Okay. Non-trade interest. Okay. Non-trade interest received should be deducted when calculating the adjusted trading profit. See, your non-trade interest receives an income, but it it does not form a part of your trade. So for your trading profit, you have to deduct this. Okay, the non-trade interest received you have to deduct when you're calculating your adjusted trading profit, and rather include this separately. Do not include it under your trading profit. The non-trade interest received should be shown separately. Okay, so it will be your non-trade loan relationship credit. Credit means it's your income. Debit means it's your expense. You will include the non-trade interest received, but not under trading profit. Separate as an interest income. Now, the non-trade interest payable, the expense, you have deducted it. Now add back to your trading profit. This is the adjustment you have to do. Non-trade, I'm talking about non-trade, not trading. Trading is no issue, no adjustment, but non-trading. Income you deduct, expense you add. So this is known as your non-trade loan relationship debit. See, in your exam, they might give you this term only. Non-trade loan relationship debit, non-trade loan relationship credit. You have to understand immediately the what you see. Credit means income, debit means expense. So this is okay. Remember, you add back to the trading profit, but you need to deduct this from somewhere. It's an expense. From where do you deduct it? From your non-trade interest income. So non-trade interest income, non-trade interest expense. They offset each other in your TTP computation. This is an area where students can make mistake. They can go wrong. Okay, I'm just pointing you towards some common mistakes now. So as such, the amount of your non-trade interest income will be accessible in the accounting period and is reduced by non-trade interest payable. So your debit and credit, you aggregate them together, and the net credit is taxed as the part of the company's TTP, the net one. From your income, interest income, you deduct the interest expense, but it has to be non-trading. Both your income and expense has to be non-trading. Then only you can offset. You can't trade trading expense, trading interest expense with non-trading income. No. Okay. So pro forma 1.1 C and activity 3. In order to apply the loan relationship rule, you have to identify whether the interest payable is for trading or non-trading purpose. So some exam advice. The relief of a net deficit on a loan relationship is specifically excluded from the syllabus. So you will always get excess. That means what? Your income will always be more than your expense. That means it will be part of your TTP where you have to pay tax. Because if it was the other way around, your expense is more than your income, it would be a net deficit. You have to get a relief for it. So that relief, they are saying, will not be asked in your exam. It is excluded from your syllabus. So you will always have it one way. Interest income will be more than interest expense and will form part of your TTP. Okay. Now, so trade purpose includes loans too. Now we are moving on to trade purpose. When you are giving a loan to purchase plant and machinery that you want to use in your trade. When you are giving the loan to provide working capital. When you are giving the loan to purchase property used for trading purpose, such as office, warehouse, factory. Now, the non-trade. Non-trade purposes means when you are giving the loan to purchase property for letting it out, or giving the loan to acquire share of another company. Note, interest receivable or payable to HMRC is accessible or allowable as a non-trade loan relationship income or expense. Okay. See, as I told you, for any business, the interest receivable or payable to HMRC is your non-trade loan relationship only, because it's not in your trade, no, to lend money. It's for banks only. If bank is calculating TTP, for them it's a trading. Yes. Now, the loan interest receivable is generally always non-trading. If you see the interest that you have received is always non-trading. You do not receive interest receivable for your trading purpose. Okay, as I told you, unless the company's trade is lending money, very rarely it would be like that, right? Now, so activity 1 where you're supposed to calculate TTP for Charles. This is a very good question. Okay, accounting reference date has been given to 31st March. Year ended now. Before tax, your profit is 2 million. Now, charging and crediting. So you have been given expenses and income. You have to do the adjustment. So you can see interest payable, trading purpose. QCD, entertaining, depreciation, dividend received, bank interest received, paid and royalty received relating to trade. If it's relating to trade, they will tell you specifically. Capital profit on sale of office block. Now, sale of the office block give rise to a chargeable gain after indexation. As I told you, companies need indexation. What is this indexation? You will soon come across in the next lecture of 2:30. Okay. Now the company's plant and machinery capital allowances is 40. Company paid dividends 140. Calculate TTP. So now using the pro forma and understanding of non-trading relationship, QCD, then the dividends, then disallowable expense, allowable expense. Now we are going to calculate TTP. So when we do a question of this type, we are supposed to calculate TTP. Remember, a starting point is your profit which is given before tax. It will be given to in the question. So in this case, it is the profit before tax of 2 million. Okay. So we'll adjust that. So now we need to calculate that first. So let us quickly do that. Okay. Profit before taxes 2 million. Done. Now one by one from this list. We'll go in the order given. So first is interest payable for trading purpose. Okay. Remember, sum does not require adjustment. Okay. So interest payable for trading purpose 900,000. Do it need adjustment? No. This does not require adjustment. The first one. Interest payable. Why? It's an allowable expense. It was supposed to be deducted and it has been deducted correctly. So that interest payable, we do not do any adjustment with it. Next item, qualifying charitable donation of 12,000. QCD. QCD, you have to, what do you do? Add back. Qualifying charitable donation has been deducted. Now you add back with 2 million. Because it will be deducted somewhere else after our this side. From the total profit. So minus 12,000. Sorry, it's not minus. It will be added. I'm sorry. You are doing adjustment. Next item. Entertaining 5,000. Entertaining is also a disallowed expense. It needs adjusting. You have to add back. Next, depreciation 30,000. Depreciation is what about depreciation? That also is not allowable. So depreciation you have to add back. 30,000. Now, dividends received 9,000. Dividend received was an income. You are not supposed to add. Now you have to deduct it back. 9,000. Deduct. So minus 9,000. Then bank interest receivable. What about bank interest receivable? 40,000. You have to deduct it. You're not supposed to deduct it as an expense. Sorry, add as an income. Now you have to deduct it. The 40,000. Minus 40,000. Now, what's next? Patent royalties relating to trade. So patent royalty, you do not have to do any adjustment because it is relating to trade. It's an allowable expense. Allowable, okay? So that income you can take. Then capital profit. Capital profit 350 is, you can't take it as a profit in the trading profit. So you have to deduct it. Minus 350,000. Now, one more thing. Capital allowance. Do not forget capital allowance. So capital allowance you have to deduct. So company's plant and machinery, capital loss for the period is 40,000 minus 40,000. So now you are going to get a adjusted profit. So we have got our adjusted trading profit. Why adjusted? Because we have adjusted the figure. Often this is the first figure when you're calculating your corporation tax. So now adjusted trading profit. You see why? Because this has a formula in it. That's why. So when I want to copy this, what do? I put dollar sign. Okay. To the row. Not to the column, not C. Before 47, after C. Before 47, and here also after C, before 47. Now, when I copy paste here, see what happens. You see, it is copying exactly the same thing because I put a dollar sign and I have locked it. So now, what's next? I need my total profit. Okay. Working was required for this. So this I will show like this. Okay, this was my working. Now, what's next? Next type of my income was bank interest. You see, bank interest is not a part of your trading profit. Keep it separate. Understanding? So what is bank interest? The bank interest receivable 40,000. Now, what's next? Chargeable gain. So say the office gave chargeable gain 230,000 after indexation. Chargeable gain. 230,000. So now check whether any other profits are remaining or not. Interest is done, chargeable is done, trading is done. Okay, nothing. So now we are going to use the sum function to find the total profit. So we have got now, this is known as total profit. Now we are going to deduct our QCD, qualifying charitable donation, was 12,000. This is the right place to deduct QCD. That's why it is not taken from an expense. So this will be your total taxable profit or taxable total profit. Anything, okay? You can say it's TTP, some function. Deduct from total profit QCD and get it. So your TTP is 18666000. Okay. Now, if you see dividend received 9,000, this is ignored in corporation tax computation. Okay. So that's why we did not put it as a part of TTP. So dividend received, this 9,000 is exempt from corporation tax. That's why it did not form part of TTP. And what about this dividend paid 140,000? This is an appropriation of taxed profits. Okay, it is not to be deducted as an expense, not allowable. So this is the answer for it. We have done the working to find this. Rest all you can get from the question as it is, and deduct the QCD from here because this is the right place. That's why we have added it here. Now, next section, the second section is capital allowance. This is very easy section. Even though a lot of workings are there, a lot of steps are required here, but this is one of the easiest to score the highest mark, whether it's for personal taxpayer or for companies. Okay, so for calculation of capital allowance for company is same as for income tax. Okay, in the context of trading profit for tax purpose being calculated under accrual, not cash. See lecture 7. If you are preparing it under accrual basis, companies anyway prepare it under accrual basis, but for individual taxpayers, there's a choice, cash or accrual. Now, the capital allowances for individuals are treated as a trading expense for the period of account for income tax. What do? You find capital allowance, deduct it from the profit, trading income for individuals. But for corporation tax, they are calculated for accounting period. There you calculate for period of account, here. Now, the key differences. So these are some key differences with companies and individuals. First one is you're writing down allowance. So your WDA to an asset that was subject to a private use by an employee of the company is not restricted to reflect the private use. Why? This is because the private use is a taxable benefit for the employee. See lecture 5. See, if it was used by an employee, the private use by an employee of that asset is ignored. We do not take that into consideration for the WDA. It is only the employer's thing we take it into consideration. Then, the private use adjustments are not relevant for your corporation tax purpose. They only apply to unincorporated businesses that we have done. That's why we have done a separate column, remember, for private use, but not for corporation tax. Corporation tax, in fact, capital allowances are easier for companies compared to individuals. Now, this is a common error made by some students in exam who apply private use adjustments when calculating capital allowance for corporation tax. Don't do that. Next, short life asset election. This is why I always tell you, go back to my lecture 7, then only you will understand what is this writing down allowance, short life asset election. Otherwise, you will not understand this. This itself will not make any sense to you. Okay, so short life asset election for corporation must be made within 2 years of the end of accounting period. So if your period ends 31st December 2024, then by 31st December 2026, 2 years after that, you have to make the election. For structures and building allowance, this also we have covered. Questions in the exam will only be said where construction is or on or after 1st April 2020. Then The next difference, if the accounting period is less than 12 months, what do we do? That is short period. Your WDA, your AIA, we prorate downwards, but remember not your FYA, okay? And also your small pool allowance, 1000 and less, are prorated downwards. This is for income tax. But if it's for company, and if they're preparing accounts for less than 12 months, what do? They can never be assessed to corporation tax for a period exceeding 12 months. Remember, for long period of account, you cannot prorate upwards for companies. For individuals, yes. For sole trade and partnership, not for companies. Companies, you can always prorate downwards. Okay. So this same rule applies for the calculation of capital allowance. Same rule means you prorate downwards only. Your WDA and AIA. How you used to do for individuals. Same for company. Now, for company, there is an enhanced capital allowance. We'll cover this next section, 2.3. So, coming to enhanced capital allowance. This is available to companies when they purchase a new plant and machinery from 1st April 2023. Remember the date. There are two rates of enhanced allowances. First one, FYA 100%. For expenditure which fall into the main pool. This is known as full expensing. Next is 50% FYA for expenditure which falls in the special rate pool. Okay. Now, so only expenditure on new plant and machinery qualifies, not expenditure on second-hand assets. Remember this. Cars do not qualify for these enhanced allowances. Cars are out of this picture. So these allowances are not even available for sole trader or partnerships also. Only for companies. As with other FYA, relief is not prorated for short accounting periods. Remember how FYA normally we do not prorate downwards. Enhanced FYA also we don't. So the expenditure which will also qualify for annual investment allowance. If you see for plant and machinery, if you are buying it, you will also qualify for AIA, right? But where the 50% FY is available, this is for special rate pool. It will generally be beneficial to use the annual investment allowance first to get the relief at 100%. If you compare, which is better, AIA or FY at 50%? AIA, because you are getting it at 100%. Any balance over 1 million, that is your AIA limit, will be eligible for 50% FY on the balance. So first take AIA 100%, then on the balance take 50% FYA. Now example 1. So we are going to calculate enhanced capital allowance for ENCO. Tax written down value at the special rate pool and main pool has been given as 90 and 250,000. You have purchased a new machinery for 3.5 million, which is main pool, and new equipment for 1.5, which qualifies as special rate pool. So let us calculate. So now for capital allowances, we are supposed to draw the columns. The 3 columns: special rate pool, main rate pool, and the allowance. So this will be your special rate pool, SRP. This will be my main pool, and this will be my allowance, A column. And then, so first we are going to write the tax written down value at 1st April 2024. So it's given as 90,000 to 50,000. Then additions qualifying for AIA. So additions qualifying for AIA will be, first we are going to take the special rate pool item. See, both will qualify for AIA, then plant and machinery as well as the equipment. But we are going to first utilize the equipment, 1.5 million. Why? because it qualifies as special rate pool. So equipment. And then your AIA, if you see limit is 100%, but limit is only 1 million. So 1 million only minus, and this 1 million is an allowance. So immediately we'll update in the allowance column. So what is the balance? The balance will go use sum function in the special rate pool item. Okay. But normally we do this, right? But there is a twist here. Now we are eligible for the remainder of this 500,000. Will be eligible for 50% FYA also. So this will not go in the special rate pool any longer. Understanding? Because it will be qualified by 50% FYA and 50% FYA because it is special rate pool item. It is 50% FYA. Understanding? So, and no more AI will be eligible for plant and machinery because we have utilized the 1 million for 1.5 million entirely. So now we are going to calculate WDA. First WDA, then FYA 150%, which is enhanced capital allowance. So here we are going to calculate, write the percentage. Now WDA at 6%, special rate pool item, and main pool 18%. So here we are going to take minus 6% into this because we have to deduct it. And then this 5,400 is an allowance. So we'll write here. So we are going to copy paste it here, not here. And then here it's minus 18 equal minus 18% into the main pool item. Yes. 45,000. So 45,000 is an allowance. Done. Now we need the total sum function. Done. Now we are going to calculate additions qualifying for FYA. So first machinery, FY is 100% because it's the main pool item. So machinery was 3.5 million. We are going to deduct the entire amount. So this is an allowance. This 3.5. Next is your equipment. Remember 500,000 the balance. So 50% FYA. Minus 50% of this sets 250,000. Now, this is a special rate pool item, so it will go here. The balance 250. So now they have written down value at 31st March 2025. Sum. And then the total allowance. So this is your total allowance. 4,8,400,000. So this is the answer for example 1, where we have got our total allowance. So first we have taken 100% AIA for special rate pool. The balance 500 we have taken 50% FYA, but before this we claimed WDA. Okay, and machinery 100% FYA because it goes in the main pool. Now, disposal of assets on which enhanced capital allowances are claimed. This disposal are treated separately from other assets. The proceed on sale of assets which 100% FOI has been claimed will result in a balancing charge of 100% of the disposal value instead of the proceeds going into the main pool. So rather than the proceeds going into the main pool, there will be a balancing charge of 100% of disposal value which arises. For those assets where 50% FOI is claimed, 50% of the proceeds are deducted from the special rate pool and 50% of the proceeds are a balancing charge. This is because 50% FOI was claimed on acquisition and 50% of the acquisition cost went into the special rate pool. So however, there's a restriction if FOI was not claimed on the full amount of initial expenditure. For example, if AIA was claimed on part, we'll see this in section 2.5, the restriction part. Now, example 2. So it's about hall, taxation down value. In the special rate is 20,000, main pool is 0. So during the year, he has sold equipment. Proceed 35, 100% FYA. Now, same here. Equipment for proceed 60, where 50% FYA was claimed. So now, we are going to calculate the balancing charge. So this has been calculated. So what do we do? First one is 35,000. We are going to deduct as it is. In the next one, 60,000 proceed, we are going to take 50%, so 30,000. And then special rate pool we are going to deduct. What is it? What is the amount in the special rate pool? 20. 50% of 20 is 30. So from 20 minus 30 is 10,000, the difference. If you add all them, this is your balancing charge, 75,000. Now, moving on to the restriction, where enhanced capital allowances are restricted. So there is a further restriction. If a plant and machinery is sold and enhanced capital allowances were not claimed, you have not claimed on the full amount of initial expenditure. This restriction will not be examined in regard to 100% FYA. As in most cases, the first year allowance will have been claimed on the full amount of expenditure. Normally on this part they don't ask. It's on the 50% FYA. So when it comes to plant and machinery qualifying for 50% FYA, sometimes it might have been beneficial to claim 100% AYA. Entire amount goes. So you don't have anything to claim under 50% FYA. In that case, you might not claim, or you might partially claim 50% FYA. In that time, this restriction comes. Now, so where only part of the original expenditure obtained first year allowance at 50%, that means not the full expense, only part, then only that proportion of disposal proceed gives rise to a balancing charge. The remaining proceed will be deducted from special rate pool Okay, the sale proceed proportionate to the original purchase price should therefore be calculated. Understand this, the sale proceed proportionate to the original purchase price should be calculated, and 50% of this amount should give rise to a balancing charge. The other 50% along with the sale proceed proportionate to the amount on which AI was claimed and deducted from special rate pool. If you are not understanding this through sentences, don't worry. Through questions, I will show you the demo. So exam advice. The amounts deducted from special rate pool can be shown separately if candidates find the separate calculation easier to follow, or the amounts can be combined and deducted from special rate pool if candidates find this simpler, whichever. Now example 3. So here the tax written down value for special rate pool, only special rate pool they have given. Thank God they did not give it to unconfused, because this is the first question under the restriction. 350,000 in the value. Now, during the year sold equipment for 275. Originally equipment was purchased for 1.3, claiming annual investment allowance of 1 million. So 50% would be claimed on the remaining 300,000. Now let us calculate. So for example 3, as I told you, we need to draw the columns. Since there is no main pool, we will only have one column, which is the special rate pool. So this main pool I'm going to delete because it's there from the previous one. Now, what do I need first? Proportion of the sale proceed of which 50% FYA was claimed. I need that proportion first. So let us first find that proportion. Okay. I'm going to do it somewhere here. Proportion of the sale proceed on which 50% FYA was claimed. So sale proceed was 275,000 multiplied by 50% FYA will be claimed on what? The remaining 300,000. So it's 300 divided by the full amount, 1.3 million. Drop down the decimal. 63,462. Now, the remainder of the sale proceed are proportion on which AI is claimed. AIA. So, sale proceed is this minus this amount. 211,538. So now we want to find the overall balancing charge. Okay. So it is 350,000 in the special rate pool. So date is same. Now we have disposal. So first we are going to deal with part relating to 50% FYA. Part related to 50% FYA. So if you see here, it will go in the allowance column. Remember, it's a balancing charge. 50% is the charge. So it will be negative 50% of this amount. We'll drop down the decimal. 31,731. So this is 50% of this is the balancing charge. This is balancing charge. 50%. 50% of this will be balancing charge, okay? Relating to 50% FYA. Now, 50% relates to special rate pool, which will be deducted from special rate pool. special rate pool. So the other half you're going to deduct from here, equal to, just copy paste this. Okay, so 50% you see, out of this 50% will go in the allowance, 50% from special rate pool you have to deduct. This is a balancing charge, BC. Now the part relating to AIA. Part relating to AIA, 50% you will deduct here, this amount. Already you have calculated, you will deduct here from the special rate pool. Equal to minus this amount, done. Just put minus and click it, automatically the number will be converted into minus. So now we want the sum, the total sum function. It has to be deducted, okay? This. So 106,731. Now you have to calculate WDA at 6%. This is a special rate pool. So equal to minus 6% to this. Okay, 6404. So it's an allowance 6404. This is in positive. Now WDA at 31st March 2025. So you have to deduct this from here. Now our concern is on the overall balancing charge, BC. So the total of this two is 25,327. It will come in negative only. If it was a balancing allowance only, it would come in positive. Balancing charge, it will be shown in negative. Okay. Activity 2. So this is also about ANCO from example 1. In the year ended 31st March 2026, they are selling the special rate pool equipment and receive proceeds of 900. So you have to calculate the capital allowances for year ended 31st March 2026. Okay, so this is brought forward from example 1. Now, so the special rate pool that they have bought was for 1.5 million. And they have claimed AIA of 1 million. That means the remaining is 500,000. So how much was the equipment they have bought? 1.5 million. This was our general brush. AIA. $1 million. So you're left with 500,000 on which 50% FI was claimed. Now we have to find the proportion of that. Okay. So here we are going to use the sale proceed 900 this time. This is the proportion of the sale proceed on which 50% FI was claimed. Okay. And it would be 500,000 on which FI will be claimed, and the total amount of equipment is 1.5 million. This is equal to, see, it is 300,000. So if this is 300,000, this would be easy. Just take the sale proceed 900 minus this, on which FY was claimed, equal. So 600,000. Now we have already got this. You have from example 1 you need to bring forward. Okay, at 31st March, March 2025. This is already given, the main pool and the special rate pool. So I'm just going to add another column here, main pool. So the amount was 3, 4, 3, 3, 4, 600, and this one was 205,000. This is from example 1. Okay, now the disposal. So 50% on which FI was claimed. Remember, 50% only you will take in the allowance column. Here, 50% of the 300, which is 150. Done. Next, the another 150 you will deduct from the special rate pool here. Okay, and part relating to AIA, 600 you will deduct. So total is 415, 400. This is your balancing charge, 415, 400. This will come as negative because it's a balancing charge. Okay, then you need WDA at 18% because there is nothing remaining here. You see, there is nothing remaining in the special rate pool for you to take WD at 6%. Hence, only main pool item 18% you will take. Equal to minus 18% into 36,900. This 36,900 is an allowance, so you will write in positive. So it's 528,500. This is your total allowance. No, it's balancing charge. So this is the answer for example 3, where we have got the balancing charge. Remember, from the sale proceed we take the proportion like this, on which 50% FI was claimed, and then the balance we deduct this amount from the sale proceed and find this on which proportion of AIA was claimed. Okay, so if this 50%, okay, 50% as a balancing charge, which is here, the other 50% we deduct from special rate pool, and whichever part is relating to AIA we deduct from the special rate pool item and claim 6% WDA, and hence this is the overall balancing charge which will be shown in negative. Now the same is for activity 2, except the amount are changed here. Okay, so 150, 150, this is same, 50, 50, 600 related to AIA. Okay, now we are moving on to enhance capital allowance for expenditure incurred between 1st April 21 to 31st March 2023. So for 2 period, companies could benefit from the following enhanced capital allowance when they purchased new machinery. For the main pool, they are getting 130% super deduction. This meant for every 100 of expenditure, first year allowance is 130. For special rate pool, there was a 50% FYA. Now, this enhanced were not available for sole trader or partnership. Only expenditure on plant and machinery qualified. not expenditure on second hand. Cars did not qualify. So exam advice. A question will not be said when enhanced is incurred in accounting period spanning 31st March 2023. Okay? Because the tax rates of 22-23, the corporation tax rates are different. So they will not ask this. They will not make it more confusing. Now, any disposal will be set in an accounting period after 1st April 2024. So for expenditure which fell in the main pool, 130% super deduction. When plant and machinery on which 130 super deduction has been claimed is sold after 31st March 2023, what happens? The sale proceeds are not deducted from the main pool. How we used to deduct from the special rate pool. Instead, the proceeds are bought in as a balancing charge. And for expenditure which is in the special pool, 50% FY is claimed, and when you're selling that plant and machinery, 50% of the sale proceed are deducted from the special rate pool and other 50% as a balancing charge, the same way how we did before, where lower original cost is used instead of disposal proceed. Okay, lower of original cost and disposal proceed. So the deduction from the special rate pool could result in a balancing charge on the pool itself if the deduction is more than the tax written down value. This we have seen in the previous two questions. Now, the relevant rates of allowance will be given in the exam question where there's a disposal of plant and machinery on which enhanced capital allowances has been claimed. So the rules on disposal of assets on which enhanced is claimed are same for the enhanced capital allowance for assets purchased after 1st April 2023. They are the same, except for the fact that the main pool assets are now only entitled to 100% FYA rather than 130% super deduction. Remember this. The dates matter a lot. If it's after 1st April 2023, you do not get the super deduction 130%. Rest everything is same. But if it's for expenditure incurred between 1st April 21 to 31st March 2023, only for these 2 years, that time only from the main pool, that 130% super deduction is available. Only 2 years. You have to see the dates. Now, the planning for companies. So where there is one type of allowance, some assets are eligible for more than one type of allowance. You have to consider all the allowances to ensure that capital allowances are maximized. So AIA, if you see AIA is available on second-hand assets, but FYA is not because it's first year allowance. Therefore, you have to consider using AIA on assets which do not qualify for FYA. Expenditure which qualifies for 50% FYA will also qualify for AIA. But it is better to qualify AIA first, then on the remainder claim 50% FYA. Now, AIA, when you are doing AIA, you should give that priority to the should also be used in priority to the 100% FYA. Remember, when you're using AIA, your AIA is also 100%, 100% FYA is also 100%. But the priority still should be given to AIA. Okay? Even though the amount of relief, whether you claim AIA or FYA is same because both are 100%. But the treatment of subsequent disposal, when you dispose later, will normally be preferable when the AIA has been claimed first. That means proceeds deducted from the main pool rather than the 100% FYA is claimed and the proceeds result in a balancing charge. You see, better to claim AIA because if you claim 100% FYA first, remember the proceed will result in a huge balancing charge, which is not good. So for companies to maximize capital allowance, AIA should be used as follows. Initially against second-hand assets, then against those assets that qualify for 6% WDA, that is special rate pool, then against main pool, then against new assets falling into the special rate pool, that is 50% FYA, then in preference to those assets which qualify for 100% FYA. There is no upper limit for 50% and 100% FYA. So, therefore, they should be considered after a company has exhausted their AIA. Now, example 4. So here, about band, tax written down value in the main pool is 0. Both main and special rate pool is 0. So they have purchased some second hand, some new hand. So new main and special rate pool 360, 450, 310,000. Now you have to calculate the capital allowance. So first is AIA. First we'll calculate against the second hand. This is number 1, 450. Then we'll calculate against the 310. This is number 2. And then against this special rate pool. So remember, it's up to 1 million limit. So when you add this, another 240 you can add, okay? Because to make it 1 million. You understanding? So out of this 360, you can only claim the balance. So from 1 million, deduct this 450 and 310, the balance at 100%, which is 240. Then comes FYA on the balance. So 360 minus 240. If you see, main pool expenditure is 360, but you have only claimed 240 for AIA. The balance, you can claim 100% FYA because it's main pool item, which is 120. Add together, this is your total allowance. Now, moving on to the third part of this lecture, property business income. This is also something which is easy. So, generally the rules for assessing property income, whether for income tax or corporation tax, is same, but there are some differences. This difference, the individual part for individual taxpayer property income, I have done in lecture 3. Now the differences are rents, add the income element of short lease, deduct expenses, and get your property income. Up to this much it is same. Now difference. So the the profit or loss for corporation tax purpose arising from letting a furnished or unfurnished is determined for a period of account, usually the same as accounting period as opposed to tax year. Property income is always taxed on accrual basis. There is no cash basis for corporation tax. Allowable expenses are also same as for income tax. So you can see lecture 3 for it. Except for the following. These are the difference. First one is on loan interest. So the loan interest payable on loans taken by a landlord to let a property is not treated as a property income expense for corporation tax. You see, for income tax, it was taken as a property income expense. You deduct it from your property income. Here, it's not the same because it is a non-trade interest payable. Under the loan relationship rule, it is deducted from your non-trade receivable by the company. Non-trade interest receivable. This is the difference. Second difference, capital expenditure is not an allowable deduction for companies. So therefore, capital allowances can be claimed on expenditure on plant and machinery used in the business. Replacement furniture relief is available for replacement of domestic item in residential property. In respect of car, company cannot choose to claim HMRC approved mileage allowance. Okay. So they can claim capital allowances and car expense, but not mileage allowance. A personal taxpayer, sole trader and partners could do that. Then losses. Losses which arise when expenses are more than income. What happens? Then the loss relief for property business losses of company will be dealt in chapter 19. We'll cover this in chapter 19, where we are going to go through loss relief. Property business income activity 3. So here C will have some profits. So let us go through it. Trading profit. Adjusted for all items except interest. Okay. Payable on loan. taken out to purchase a property B, and bank interest receivable and property income. See below, you have to calculate that property income. You are supposed to calculate corporation tax liability. You have to take two things. First find property income, then find corporation tax. Okay. So this is about two property A and property B. Both are commercial property. Property A, you are letting it out. You are getting a rent of 2,000 per month. Expenses are all allowable, 5,500. This is easy. B. And you have purchased, has been let throughout the year. For the whole year, you don't have to apportion it. Property B, this you have purchased on 1st Jan 2025 and let from 1st March 2025 at a rent of 3,500 per month. A lease premium of 100,000 was received on 1st March 2025 for a grant of 15-year lease. Two things are here, rent from property and lease. You have to add. The property was purchased with a need of 250,000 loan. Interest is 1,700 per month. Other expenses are all allowable, 12,000. There is a plenty of work to do in property B, but we'll break down this big chunk of information into small pieces and we'll handle this question. So let us start. So now we are going to list down all the income and the expenses of both property A and B and find the total. Okay. So first, property A, B and the total. So first it is rent. Rent receivable. For A, it is straightforward. It is 2,000 per month. So 2,000 into 12, 24,000. And for B, it is only for 1 month. You have let out from 1st March. So from 1st March to 31st March, 1 month, 3,500 only. Now, the lease premium. So we don't need. So the lease premium is 100,000. Remember this inside column, I'm keeping it for working, okay? Then deduct my capital element. How do I deduct my capital element? Equal to minus 2% into this, the lease premium, into how many years? 15 years. So 15 minus 1, which is 14, is 28,000. So here I'm going to do the sum function, get the total, which is 72,000. This is the income element, 72,000. This 72,000 is for B. Next, going to deduct the allowable expense. So expense we are going to deduct from here. For A, the allowable expenses is 5,500, and for B, the expenses were 12,000. Now we are going to find the total. Remember, A and B are led by same person, okay? So we can aggregate the two. This is 3,500. Okay, so this is 82,000. Now, so we'll go here and write it under the trading profit. So trading profit has been given as 500,000. Then comes property business. No, first we have to adjust the interest. We have to add back the non-trade interest and deduct the non-trade interest payable. Add non-interest payable. Add the non-trade interest payable. If you see the non-trade interest, you see 1,700 beginning in Jan. So for 3 months, Jan, Feb, March, 3 months, 1,700 into 3. You have to add it with your trading profit. Because this was before you had adjusted for interest, the trading profit. Into 3. Then so your profit has been adjusted as 505 1. This is trading profit. Okay, now we have interest receivable. $9,000. Already they have given us 9,000. What do? Deduct the non-trade interest payable from here. Deduct that this 5,100 from here, from bank interest receivable. Non-trade interest payable and get the total. $3,900. Now you add your property business. Property of this 82,000. And get your TTP. So it is the sum of your trading profit, interest and property. 591,000. Now on this, which year is it? 2025. And if you see, this is more than 50,000. So main rate 25%. 25% will apply on this. So this is your corporation tax. 147,750. So this is the answer for activity 3, where we have done adjustment with the non-trade interest. So we have added this 5,100 with trading profit. This is an adjustment, whereas actually it was supposed to be deducted from the interest receivable, which we have done. So then we got the trading profit, the interest income, and the property business profit. The three types of income we add and we get our TTP, on which we charge 25% corporation tax. So this 82,000 was calculated from property A and B. Now, the fourth part of this lecture, long periods of account. If there are long periods, that means company is having period of account more than 12 months, you need to divide it into two periods, two accounting periods. One, it should always be one for the first 12 months and the other is the balance. For example, if you are making an account up to 18 months to 30th September 2024, so first 12 months, year ended 31st March 2024 and the balance 6 months for up until 30th September 2024. Now, how do you allocate the profits? This is how you do. This is the basis. If it's adjusted trading profit before capital allowance, you time apportion in months. If it is capital allowance, separate computations for each accounting period. Why there's an asterisk mark? Because if your accounting period is less than 12 months, your WDA and AI will reduce accordingly, but not FYA. Coming to property business profit, time apportion in months. Non-trade interest, accrual basis. Chargeable gain, date of disposal. Charitable donation, date paid. Miscellaneous income, time apportion. And dividends, date of receipt. So you need to remember this basis when you need to divide between two accounting periods. Now calculating the tax liability. So once the TTP has been calculated separately for each accounting period, we calculate the corporation tax, okay, for the two accounting period. Now, activity 4. You need to calculate the corporation tax for the two accounting periods. So this is for 18 months, first 12 months and the balance 6 months. Now, so we have been given the adjusted trading profit before capital allowance and item on the main pool. There were no disposal, but a second-hand machinery of 30,000 and new zero emission new electric costing 20,000 were purchased on 1st August 2024. So you have been given the profit, the property business profit for 18 months. Bank interest received to 31st March 2024. Then capital gain, you have been given the date. QCD, you have been given the date, and also UK dividend, date is given. So now based on the basis that we have to allocate the profit among the two accounting periods, let us solve this activity 4. So whenever we are given a question where we are supposed to calculate corporation tax for two accounting periods, we'll put both the periods in the different column. So this one we are going to put year ended 31st March 2024. And this one six months to 30th September 2024. Now, so first we'll be doing the adjusted profit. So adjusted profit has been given to us. How much? 315 before capital allowances. So this 315,000 we are going to take it for 12 months out of 18, which is this. And here 315 for 6 months out of 18. Now we need to deduct from adjusted profit itself. You have to deduct capital allowance, not at the end. So capital allowances, you need to do, there is a working one to see, whenever you have a working inside, refer like this, and working one will be shown separately. Okay, then we will get our trading profit. This is the end result. So we'll give capital allowance separate, then property business profit. So property business profit, property profit, property profit also same. You have been given 27,000, you have to portion it 12 and 6 months. So 27,000 equal 27,000 into 12 for 12 months divided by total is 18 months. So it is 18,000. To find the balance is very easy. From 27,000 just deduct this one. You will get it. Another way of getting it. Now comes your next, bank interest. Remember, when we are writing bank interest, you have to write non-trade interest, trading interest or non-trade interest. In this case, it is non-trade interest because you are not a bank institution. So non-trade interest, you have to show like this. Non-trade interest is when it is receivable. So non-trade interest, if you see, it was 11,000. When did you receive it? 31st March 2024. So that 11,000 will come here. Nothing will go here. Okay. Now, what's next on the list? Capital gain, so chargeable gain. That also depends on the date. 106,500. So chargeable gain you have made in the 6 months, 106,500. It is in this time period, 106,500. Not in this time period. Now, what's next? What about UK dividend received, exempt from corporation tax? So now we have taken everything. Now we are left with QCD. Okay. So now we have to deduct qualifying charitable donation when paid. You need the total. So we'll put the sum function from here. And same thing will be copied here. Now, less QCD. QCD will be deducted based on the days when you have paid. So here 8,000 20th December 2023 and the next one is 24th July 2024, 6,000. So here it would be minus 8,000 and the 6,000 will be deducted from this period. Now your TTP. Perform the sum function. I'm going to take it here. Okay. Now on once you get your TTP, see, to get your corporation tax rates, you need to find your augmented profit. Augmented profit will be, how will you get augmented profit? By adding the dividend with the TTP. So if you are receiving dividend from non-group companies, you are receiving, see, if it's group companies, they will specifically mention group. If they do not mention anything, they will just say UK dividend or dividend. So it is from outside the non-group. So you will be adding dividend from outside the group. What is the dividend? 1st August 2023, you are paying 36,000. It falls in this period, minus 36,000. And here it is 0. Now we will be getting our augmented profit. You need this augmented profit to decide your rate of corporation tax. That's it. That is the only purpose of augmented profit. Do the sum function. It's not minus, it is addition. Okay. So now remember one thing. What is it? You need capital allowance here. Then only the other figures will be adjusted. Automatically it will be adjusted since I have the formula in it. So you don't have to worry. Just you need to calculate capital allowance and put it in the column. So now we'll be doing the capital allowance. Working here. Okay. So I would be needing 3 pool. This is main pool. This is the allowance column. We don't have any special rate item. Now, so first is 12 months to 31st March 2024. There is no issue with this. So we will be having the written down value brought forward. So what is the brought forward balance? If you see, it is 80,000. Okay. So it's 18,000 in the main pool. Now from this 18,000, I'll be deducting 18% WDA. So here minus 18% of this. This I will take in the allowance column 3240. This is 80,000. It's 14,400. I'm sorry. It's 80,000, not 18,000. This is the balance carried forward. Carried forward balance 65, 600. Now 6 months to 30th September 2024, the next period. So remember, when did you buy this? You purchased on 1st August 2024, both. So it falls in the 6-month period. The 12-month period is straightforward. Just WDA on the main pool balance. Okay. Always write the period to which you are referring the capital allowance to on top. 6 months to 30th September 2024. So now additions qualifying for AIA. Your how many item is there? There is 1 car and 1 machinery which will qualify for AIA. machinery. So what is the amount of the machinery? 30,000. Since it is second hand, you are not eligible for any enhanced or anything. Okay, normal AIA. 30. And AIA, remember when you're taking AIA 1 million, it is for the 12 months. So you have to take AIA for 6 months. If you take 1 million for 6 months, it would be 500,000. So the total AIA is 500,000. But since your machinery is only 30,000, it will be covered under AIA completely. So this 30,000 is your allowance. Under allowance column, you have to update. Next, FYA. You haven't disposed anything, so no balancing charge will arise. Okay, car is 20,000. It will be covered with 100% FYA. This is AIA. This is FYA. So 20,000 is an allowance. Okay, we need the total allowance. Just this three. 64, 400. No, you can't add this 14,400. This is for 12 months. Okay, so when you're doing the sum function, this is why I always tell you the time period. This too. One more thing you have forgot. What is it? When you are taking before FYA WDA, you forgot in between to take on this 65,600. Okay. So now here WDA 18%. Remember you have to take for 6 months here. So when you're taking it's minus 18% into 6 divided by 18 into 65,600. So it is 3936. Is it correct? There is an issue here. There is some mistake. This when you're taking it, it cannot be 18, it's for 12. Okay, 6 months out of 12 you have to take, not 18. Five nine zero four. So this is the allowance. You see, this is the allowance. So now 55,904. This and this are the two allowances. 14,400 you will deduct from here, and from here you are going to deduct 55,904. And then here I'm going to do sum function. So now when I'm finding the total, okay, see when you're doing the sum function, there was an issue. It starts from here, trading profit. You have to include this as well. So now Your augmented profit is 252,600 and here it is 158,596. Now remember, you have to adjust your upper limit and the lower limit as well. Lower limit is 50, upper limit is 250. Okay, for the 12 months, if you see this is 12 months, right? 31st March 2024. It falls in which this is FY 2023. FY 2023 rate. So FY 2023 rate, okay, if you see this, is for 12 months, which is more than your 50,000, the lower limit, and above your higher limit also 250,000. So main rate will apply, which is 25%, no marginal relief, 25% corporation tax. So here the rate would be 25%. So your CT, corporation tax, would be this. Sorry, it's TTP. This, it's on TTP. You use augmented profit to decide the rate, but charge on TTP only. Into 25%. Done. 54,150. This is your corporation tax for the 12 months. Now, the challenge comes for the 6-month period, because some of it falls in the 2 different financial year. That's why. So now, the 6-month period, right? Ending 30th September. So it starts from April. 6 months. So it falls in the same year only. That is FY 2024. This is FY 2024. And you have to take your rates for 6 months. If your lower limit is 50,000 for 6 months, it would be 25,000. If your upper limit is 250,000, now it's 250,000 into 6 months. Now your upper limit is 125,000. You have to see whether your TTP, sorry, your augmented profit is exiting this or not. It is exiting. So you are not going to get any marginal relief. You will be taxed at the 25%, the main rate. So in this case also it's 25%. You will be charged on the TTP. You see, 25% on this TTP. So it is 39,649. So this is the answer for activity 4, the 2 periods. And here they have given the basis, 12 month and 6, and also for property business. So for capital allowance we have working 1. This is the pro forma. Then the non-trade, it is based on when it is receivable, chargeable also date of disposal, and QCD also the dates, based on the dates you will put. And then you get the TDP. So now the rates. Okay, the rate will depend on your augmented profit. So in this case, we don't have, since your augmented profit is more than this limit, TTP is beyond the lower and the upper limit, no marginal relief, it's taxed at 25%. But in this case, okay, I missed out at this thing, that there's a marginal relief for the 12-month period, because it is based on your TTP 216,600. So this 216,600 is beyond, it's less than your higher but more than your lower limit, which is 50. So it falls between 250 and 216,600. Hence, this is the formula to calculate the marginal relief. First, you find at 25%. Then, from 250, you will be deducting 216,600, your TTP, from the upper limit, and this is the standard fraction. In this case, since you haven't received any dividend, it would be same. Okay, your augmented profit would be equal to your TTP. So that's why this fraction we did not include, because anyway it will be 1, it will be same. And hence 501 you will deduct, and this will be your corporation tax. Now, this is the working for your capital allowance. So we have covered section E. On TTP, we have recognized expenditure that you can deduct from the profit, then pre-trading expenditure, how to get the relief. We know how to compute capital allowance for income tax, and then we went through 150% FYA when we purchase and dispose. Then when we are disposing assets between 1st April 2021 to 31st March 2023, we are getting a super deduction 130% from the main pool and 50% for special rate pool item FYA. Then we know how to compute business profit, the property business profits, then the interest paid and received under loan relationship rules, then QCD, how to deduct it from total profit, then finally compute the TTP. So let us summarize this lecture. We have calculated TTP by adjusting for non-trade interest payable, depreciation, capital allowance, and include property business profit as well as chargeable gain. The trading loan relationship, if it's a trading, it does not require any adjustment, and if it's non-trading, it requires adjustments. Your non-trading interest income will be offset by non-trade interest payable. Okay, and a relief for QCD will be given by deducting from total profit. Then any private use adjustments do not apply to employees of companies. Enhanced capital allowance of 100% FYA and 50% FYA are available to companies only. Then, for disposing of plant and machinery on which 100% FYA was claimed, sale proceeds are not deducted from the main pool but are bought in as a balancing charge. But when we are disposing plant and machinery on which 130% super deduction was claimed, sale proceeds again are not deducted from main pool but brought in as balancing charge. Same thing. But there is a difference when we are disposing a special rate pool item on which 50% FIA was claimed. Here we deduct the 50% of the sale proceed from the special rate pool and the other 50% is bought as a balancing charge. We have done questions on this. To maximize capital allowances, the AIA should be used as follows. Initial against second hand, then those assets which qualify for 6%, that is special rate pool item, then main rate pool item, then assets which qualify for special rate pool with reference to 50% FYA, and any remaining AIA against assets falling in the main pool, against new assets falling in the main pool. Your WDA and AIA are flexed downward but not FYA for short accounting, but it cannot exceed 12 months. This is for corporation tax, so you have to follow 2 accounting periods. Property business, okay, they are determined for period of account. Loan interest payable is treated as non-trade interest. If your period of account is greater than 12 months, you have to split this into 2 accounting periods, first 12 months and the other is the balance. Once TTP has been calculated separately for each accounting, you calculate the corporation tax as same for any other accounting period. The technical articles that you need to read, there are no technical articles for this lecture. Thank you for watching, and I shall see you in the next lecture, lecture 18, that is also a continuation of your corporation tax. And do not forget to subscribe to my channel. If you haven't subscribed, you can watch all my tax lectures under my tax playlist. Thank you.